Hello, everyone. Welcome to a brand new season of the Wealthcast, and we are kicking off our first episode of season two with none other than Mr. Sandeep Tandon, who is the CEO of Quant Mutual Fund. Sandeep, a very warm welcome to the
Hi.
Wealthcast. Sandeep, first things first, there's this one question that I have always been asking every guest on the show, and I will ask you the same question. तुम आजकल मार्केट में बहुत कुछ सुनाई पड़ रहा है, लाइक बहुत सारे लोग कई सारे व्यूज अपने प्रेजेंट कर रहे हैं. देर आर अ फ्यू who are still calling themselves as hopelessly optimistic कि चीजें अपने आप सुधर जाएंगी, सेल्फ करेक्ट हो जाएगा सारा सिचुएशन. प्रोबेबली रशिया यूक्रेन का जो क्राइसिस है रिजॉल्व हो जाएगा कोई ना कोई पॉलिटिकल इंटरफेरेंस या डिप्लोमेटिक इंटरफेरेंस से. ये रिजॉल्व हो जाएगा तो सारा कुछ ठीक हो जाएगा. ये जो पेन है ये काफी नियर टर्म तक ही रहेगा और काफी शॉर्ट टर्म सा पेन है. बट ऑन एट द अदर एंड ऑफ द स्पेक्ट्रम, और जहाँ की काफी ज्यादा skewed opinions hai, it goes to an extent of saying that we are probably heading towards the brink of a full blown recession. This is a really wide spectrum of chatter that's happening on these streets, among investors, among analysts. The first question to you in your, and we would love to hear your perspectives on the क्विंटेसेंशियल क्वेश्चन, दैट इज मार्केट क्या बोलता है. तो आपके हिसाब से मार्केट क्या बोलता है?
Okay. So let me break this question, from a long term, medium term, and near term perspective, because that will give you a better clarity. Okay. So let me start with small background so you'll understand the three phases of market and where we are heading. Okay. Uh, Very quickly, March 2020, when this COVID drama unfolded, so our risk appetite indicator was lifetime high, risk appetite was lifetime low, liquidity was lifetime high. So it's a deadly combination for a massive bull run. Okay, so that was the bull run which we started in the after that crisis, which very limited people were able to anticipate it. The fear index was itself one of the highest level. Okay, let's understand now September 2021 when we talked about that the liquidity has started drifting down, risk appetite has started shrinking, money flow towards global equities has peaked out. Okay, our perception analytics for global markets were showing signs of euphoria, and if you dissect the euphoria into value and growth, we realize that the euphoria was confined to growth, not in value. Okay, so right from September 2021 we are saying that the easy phase of bull run is over globally. Okay, and India in particularly. Okay, the easy phase. But the very interesting thing is that we are still in bull run, so you'll get some answers. Okay, we believe that we are in bull run for Asian market, we are in bull run for emerging market, particularly Asia centric emerging market, and India is one of the beneficiary. Okay, from a longer term perspective, we have said right from 2019 we have been talking about that 2020 till 2030 will be the most difficult and challenging phase in our environment in from the investment point of view. We call it wealth destruction phase, but in this phase there is also phenomenal opportunity to make money. Okay, so this decade actually belongs to Asia. This decade belongs to Asia centric emerging market, and India should not be any exception in that. Okay, rather India should be the biggest beneficiary. So if somebody asks me a decade call, clear answer is yes, it is emerging market will outperform developed market, and India will outperform the emerging market index. So India is a clear winner. Then question comes, what whether it's growth value. So I think as per our perception analytics data, which showcase some way of measuring the valuation aspect also, that has peaked out in 2020-21, which means the valuation multiples for growth stock has seen a decade top. Okay, which means your large portfolio of your portfolio should be now be part of value thesis. Okay, though we define value very differently from the traditional markets, but assuming if you define the way statically people look at the market, then the from a longer term perspective, that is the thesis which will play out quite well. Again, this is a very, if I'm talking about a longer term perspective, let's understand, look from a medium term perspective also. Okay, so from a medium term perspective, obviously you have to keep in mind the sector and the asset classes which we are talking about should play a constructive role. So when we are talking about we are constructive on value from a longer term perspective, then sectoral themes like power, energy, or media, to certain extent commodities, okay, despite recent correction, okay, anything which is which will protect your portfolio from the inflation point of view, or these headwinds which market is talking about, should be kept in mind. So I think those are the sectors should be play out quite well from a medium term perspective. Okay, now coming to, let's talk about a very near term perspective. Okay, before I come even to the near term perspective, let me also give you some answer. So the recession fear or stagflation, a lot of people are talking about now. um, the conviction level of these data points is rising. So let me give you perspective. Right from 2019 we have been showcasing that inflation, commodity prices will start rallying from 2020, and inflation will come with a bang from 2021, and it will remain elevated. So for developed market, so developed market inflation and developed market interest rates will remain elevated till 2027-28. Okay, there's a larger perspective. That is the big picture call we have. So you have to keep in mind, there's a time for value, this is a time for emerging market, this is a time for neglected, beaten down value stocks, rather than the most admired overvalued growth stock and over owned stocks. So those are the big picture differential which we are very clearly defining it. Okay, now let's talk about from a very near term perspective. Okay, now from a very near term perspective, we believe at least our behavior data points are showcasing that panic level is significantly high in the market. Okay, extraordinary fear is there. So if I have to look at the fear index for India and fear index for a couple of individual stocks also, okay, which we do that interesting work, we are spotting that some of the stock, the fear index even at higher than 2020 um, highs also. So, which is a clear indication that fear intensity has increased so meaningfully in the current environment, and this is a classic sign for a reflex rally. Okay, so now what we have to look at the two data point, which I see a lot of when we talk about. Let's say US war or Russia war with Ukraine. I don't call it the Russia versus Ukraine. It is the battle. It is the war for US currency. Okay, the relevance of dollar index or relevance for dollar was declining globally, and it's our big call. The relevance of dollar, relevance of Fed will go in next many years. Okay, the dominance of US, which used to be there for last donkey's years, will also started declining. So this is a much bigger battle which is played out, and I we believe that every war has some economic connotations. Okay, so this was the battle for the dollar of relevance. Okay, and I think that has played out. Okay, from 92 level, dollar index has moved to 105 level. Okay, and it's corrected. So it means the we are worst we have seen in terms of war fear. That's the other way of interpreting the market. Not saying that nobody can predict about geopolitical, but we look at the macro data which can be best captured through currencies market, or the risk appetite data will give you a fairly good perspective. Okay, and since as a house we are a macro house, we look at and give a lot of importance on these things. So we are very clear, the war related fear is behind us. Okay, the only fear which is still exists, or the pain point, is the crude prices, particularly the natural gas and the crude prices. So we are less impacted with natural gas, we are more impacted with the crude prices. So crude is the still a worry, and our data points clearly showcase that we are still not ruling out a new high in crude, which can happen in the current financial year. It can happen as early as next few months also. So that is the one biggest fear which we have. Once that events unfold, I also believe that that will be a classic euphoria, which lead to a massive correction in commodities prices led by crude. Okay, and this could be a substantial fall. Okay, in the crude prices going forward. But first it has to peak out. That we have not seen a desirable euphoria which is building up now. Okay, so that is the biggest risk if I have to look from India point of view. But you also keep in mind the fear of inflation which people talk about. I said the developed market inflation will remain high for a longer term perspective, but nothing is move is linear. Okay, now if you look at the current inflation globally, it is more driven by supply side constraint rather than demand supply inflation. So it is not demand driven inflation which is driving, Maybe in certain pockets, certain commodities, you can say it is demand driven inflation because fiscal stimulus is happening, so infra spending is moving up, and hence commodity prices are inching up. So some areas we can still define it. Yes, a larger macro is changing, but lot of food inflation, if I have to talk in particular, okay, is more of a constraint from the logistic challenges, war related challenges which are unfolding, and China lockdown. So if I have to really look at the way COVID fear is also started declining, I expect by July, August sort of thing, maybe August on higher side, the supply changes related challenges will settle down, and you will see that the near term inflation or medium term inflation will start declining, and market should rally after that. But key challenge is that how market reads. But I always believe this market is a very intelligent animal, he's way ahead of most of us. Okay, so you will get a sense from the market and market how market started reacting. With that, market will be ahead. Whether it is very difficult and to visualize how market will react right now, but the way data points are showcasing is that we are getting closer to an inflection point where we believe reflex rallies on card, not only India and globally. Okay, some sector, let's say talking example, IT could be a reflex rally also, but that will be a exit on higher levels. You don't have to look for buy on dips, sell on rallies for these sector. But even for value stock, these are the still a buy on dip market for many sector which I talked about. Okay, these are grossly underowned, under research, neglected territory stocks. Okay, which offer very good dividend yields also. Okay, so these are the area where we are trying to focus, because fully knowing that challenging environment, but keeping in mind the India growth story, India one of the best economy which is can be played out well when this global noise settle down, which we see signs of peaking out in terms of noise level. Okay, once it's settled down, India should be beneficiary. So whether I like to play through hedging, or whether like to pay for large cash structure, we have decided to take a call to play through 100% investment, but in a better sector. So sector rotation is the theme which we are playing out. When we see euphoria, we tend to book profit. When we see capitulation or panic, which is the case right now, we like to participate. Okay, if you can play it right, then you have still have potential to outperform the market, or at least generate some alpha in the current environment. Both from medium and longer term perspective, we remain very constructive for India. Okay, so it's a call, and I still believe if a lot of people wants to started thinking that we have already seen a top long term top is in place, I can say with good amount of confidence, uh, whatever predictive analytics model we run, we have not seen any classic euphoria what we have seen in 2008 or 2006, or very manic phase in 2000 or 1992. Nothing like that we have seen in 2022, even January 2000. We have seen some amount of euphoria globally, and Indian particularly, which is the predominantly growth stock, certain pockets, certain small swap areas. But if you ask me at the broader market or Nifty as a whole, whether we have seen a long-term top, answer is clearly big no. We have not seen. That's the reason we like to participate. Okay, but we are playing with a lot of caution. We are playing with right sector, so that is a again part of a de-risking your strategy. We are trying to play with the select sectors which will be less impacted by the inflation fear, which will be less impacted by the multiple deterioration which industry is facing. A lot many overvalued stocks are facing currently. So it's not something that you will be absolutely safe, but on relative basis you will do a better job. And if the reflex cycle which we are talking about plays out well, then we should be beneficiary of that, because as we very clearly believe that medium and long term outlook still remain constructive for India.
Right, right. Very, very, very interesting perspectives. And, among these so many things that you said, amongst a variety of important pointers that you have made, there is one that you repeatedly stressed upon, and that's the fact that the time for value play has come, right? And alongside, you slightly brushed upon the subject of how does one define value, राइट आपने ब्रीफली मेंशन किया कि हम वैल्यू प्ले को अलग तरीके से डिफाइन करते हैं जो कि जेनरिक नहीं है सो व्हाट इज द डिस्टिंक्शन लाइक हाउ डू यू define value and how do you distinguish a value bet from a value trap and how do you draw that line between a growth play and value play.
So, the way industry looks at from the value plays pure as a statical number, which is typically reflected in the valuation multiple. Let's say price to earnings or price to book is significantly low than the average or as compared to the index. You say these are value, So IT stocks trade at, let's say, 40 times, or FMCG places 70 times, and some of the stocks trade at 3 times, 5 times, 10 times of value. Okay, that's the way a lot of people look at. We don't look at that way. We believe that every stock either trades in the admire category from the behavior perspective or neglected territory. Okay, when in the behavior category, if I have to talk about when stocks start trading in the most admire category, which was the case in IT in September 2021, or the consumption names or consumer durable names globally, I'm talking about new age technology companies, they were in the most admired stage. Okay, and from a perception perspective, the perception multiples were quoting at lifetime high or multi decades high. So that's the way we define as a some amount of euphoric top, and that's the way we like to prune down our exposure. Okay, and similarly, when stocks are trading in neglected territory, and when they hit the most neglected territory, what we call it the most hated zone, that's the area, it's the inflection points. Okay, we try to capitalize, okay, through the opportunity. Like say in October to December 2020, metal was in similar situation. Okay, few months back, 2 3 months back, auto is still in that phase. Okay, wherein they are neglected and beaten down phase. And so is the case with capital goods, and so is the case with media currently, and so is the case with some of the power companies or utility companies, or some of the commodities companies still trade in that thing. Even you can talk about the in some of the PSU energy stocks or utility stocks in that zone. So it's a very classic way we look at. So it's a just one simple way we have tried to explain you. We run complex multivariance model and then try to gauge where these multiple data points are taking, because no point taking a call on one data points and get very excited or pessimist about it. Okay, so that's the reason the way we define value is slightly different from the industry, and it is much more comprehensive way where we not only look at the valuation aspect, which is the statical definition, okay, or mathematical you can define it, but we go and add a lot of behavioral data. Okay, so it's a combination of qualitative, quantitative, and behavior data combined, put together. We try to define something, and it has worked for us for a long period of time.
Right, right. So, talking about a unique approach and comprehensiveness, and the fact that it has worked for you, this brings me to my next question. आपके कई सारे funds आप manage करते हैं, और उन सभी में, especially आपके flagship funds में, there is one thing that comes across pretty strongly, and that is the turnover of every portfolio. It reflects a very, very active sort of a management जहाँ पे the portfolio is churned, and there's nothing right or wrong about it. We don't know what's good or bad about it, but it is very distinct with relative to many other funds operating in the same category. It is very distinct and unique to the funds managed by Quant Mutual Fund, and I feel the numbers definitely show that it works. It more than just works for the investors who have invested in those funds. Over the very recent period, especially when there was a lot of displacement happening because of macroeconomic headwinds, I feel the funds have performed phenomenally well. So there's clearly something working. So if you could tell us a little bit more about जब आप एक फंड मैनेज करते हो या जब आपके फंड मैनेजर्स फंड मैनेज करते हैं, तब वो क्या आपका मेथोडोलॉजी है, क्या फ्रेमवर्क होता है जिसके बेसिस पे आप सारे फंड मैनेजमेंट डिसीजंस लेते हैं?
Okay, so this is one commonly asked question or misunderstood question. Okay, so I tell you I keep on hearing on YouTube and some of the analyst community or even the wealth people talk about it. Turnover is very high. Show me one portfolio book where it talks about turnover ratios, okay, or churning. Okay, now in our portfolio management, what we learned is about rebalancing. Okay, so you have to rebalance your portfolio on a regular basis. Somebody say I do it monthly, somebody says I do it quarterly, somebody says I'm long term, I do it yearly, somebody says I do in a decade. Okay, like private equity guys, their rebalancing is on a decade perspective because they take 10 years call for those sectors. So it's a rebalancing strategy. Okay, so when we talk about churn, These are myths in the market, which we call it. Okay, we manage our money in a dynamic manner. When I say dynamic, because world is so dynamic, you can't have your traditional tools and technique, which are not going to be effective. Right? Let's say we talk about the environment. So like from 2018 till 2020, we have been saying this is the most volatile environment, okay, which you will face. The employed walls of the most of the asset class will remain elevated. We call it volatility expansion phase. In this particular phase, your traditional buy and hold approach will not deliver, and it is not deliver. It has not only underperformed in India, it has underperformed globally. Okay, so it's a question. That's the way we talk about the concept of dynamic way of money management. When our style of money management is dynamic, our rebalancing is also dynamic. Okay, when your rebalancing is dynamic, it leads to a higher churn. Okay, but just looking the churn ratio doesn't tell you anything. Okay, as you rightly pointed out. Okay, you have to look at the Sharpe ratio, what risk adjusted return we generate. That's the best way. Okay, that gives you a good of clarity. I have seen a lot of people talk about, oh, standard deviation is high. Okay, when they also make a statement immediately, the Sharpe ratio is very high, which is very good. Okay, but they themselves contradict, and they will say in the end, oh, the Sharpe ratio is high but volatility is high, is a risky fund. Okay, so either you decide whether you want to contradict your own statement, okay, or you don't understand that. Okay, so we are very clearly trying to educate a lot of people. The churn has nothing to do, okay, with your performance. Okay, the churn is clearly linked with my rebalancing strategy. Since we manage money in a dynamic manner, the rebalancing has to be dynamic, so it's a natural byproduct of that. Okay, so, and this is another myth people try to understand. Oh, we try to capture momentum and hence the churning is high. Okay, we actually don't trade momentum. Okay, we are inflection point strategists, where we try to identify the stocks are at the upper end or the lower end. When I say either at the euphoric stage or they're in the capitulative phase. So we sell at the euphoric stage and we buy on the capitulative phase. Though I can tell you it's very easy to talk about, but it's very difficult to practice. When it real lives it happens, it's not easy. Okay, and that's a day, as a money manager, we also make mistakes. So it's not like, you will get right all the time, everything perfectly. Okay, it doesn't happen, but that is our endeavor. Okay, to optimize these behavior, or human psyche sort of thing. Now how you capture the fear and greed into numbers, that is very interesting. You can say through surveys people talk about, we do it mathematically. Okay, we can quantify the greed level in the market, we can quantify the fear of a stock levels, okay, or the asset class level, or we start looking at the money flow analysis. Okay, how money shift from one class to class. So when we talk about market timing, in our VLRT framework, T is very important, and T is the function of both all three functions of valuation, liquidity, and risk appetite analytics. But the timing, the way actually timing helped me in reducing my risk. Okay, if we all talk about right place, right time, everybody wants to time the market, whether it's any professional career, whether it's an investment or business decision, the timing is very vital. Okay, but when it comes to stock market, people have this, myth. Okay, timing, somebody tries to time market, he's a trader. Okay, nobody can time the market. Yes, you can time the market through macro data. Okay, when multiple data points are showcasing something is changing. Okay, so let me give you a small example. In September 2021 or October 2021, our portfolio have a very large representation of technology stocks.
Yeah.
Okay, when we spotted something unusual, we saw something has changed and data was showing, and I was on various media channels or even our newsletter, we have talked about there are perception analytics for technology stock on Nasdaq, which is the best risk appetite indicator for the um, current environment, has peaked out from a multi-decade perspective. Okay, so we spotted that, and today we are getting the benefit with, we don't own technology names in our portfolio for last many months now. Okay, so it's a third quarter running which we don't own these names. So it's a, so this is the benefit of timing. So somebody says that timing is bad, nobody can time the market. So we are very vocal about that. For us, it's an important principle. Timing is everything. Okay, but timing not through gut feeling. Okay, not with your experience. Timing through data. We are data driven house, and that's the way the word comes from the background, that we quantify everything. Okay, And that is the beauty. You can mathematically quantify lot many things,
Yeah.
and which gives you better clarity, better thought process. If you, let's say today, when you started talking about that market is in a panic phase, people are worried, people are tense, we see these things on the distributor calls or the investors calls sometime, which we talk about. Okay, we get that sense, but since we are data driven guy, we are not panicking. We think right now people are disturbed, the fear index is on the relatively higher side. This is not the time where I would like to raise my cash. This is the time I like to play this up move, because it's a question of time. Nobody can time it exact bottom, exact tops. When data points come, okay, we have to follow the process. Okay, if it's something is changing, and if you can put through predictive analytics data points, if you can identify it, but the challenge is how well you react. Okay, data is visible, but you get carried away with your own emotions. That is something which we try to avoid in the market. We talk, never marry a stocks, but in reality never happens. When the stocks keeps on inching up, look at the excitement level people have. People feel so attached with that stock. This is, they have identified this, what return they have get, this is the best management, this is the best business they can get. All sort of thesis get built. All the analysts are so excited, and upgrades keeps on coming. When cycle reverse, the exact reverse happen, and you see a capitulative move. Okay, so this is our way of looking human psyche, and how you convert into numbers. Okay, that is something really help us, and that's the way we follow it. Okay, now we have been following these techniques for a while. Okay, it has worked for us also. So we don't want to just change, because suddenly markets, are people are finding it very difficult. I said that's why then I explained in the initial stage how we look at the long term, medium term, and near term. Okay, so yes, even let's say then if your view is not played out that beautifully, then you are de-risking with your right portfolio selection or stock selection or the sector allocations. Okay, that also play a role. So the trick is all about how well you manage your portfolio, how well you manage your risk. Like in our fund house, we don't have one fund manager. Okay, we talk about multi-asset, multi-managers. Okay, so we follow multiple philosophy or thesis in managing one. So we have a specialist rather than one fund manager. So it's a team which runs the house, and somebody is specialized in econometric models, somebody is specialized in certain sectors, somebody is specialized in liquidity, somebody is specialized in risk appetite. So it's a combination. We try to de-risk our performance, which is linked with the one money manager, which is the case in the most of the industry today. Okay, so we try to, I'm not saying this perfect, but we believe it over a period of time we have learned this is the better diversified approach. So we talk about multi-asset, multi-manager as a tagline, and we actually practice that.
Right. So for our audience, I feel the most critical takeaways for you, agar if I have to, pick the top 2 points here is, just because a portfolio's turnover ratio is high, it doesn't mean that it is being managed like that of a trader's portfolio. In fact, there is a good chance, like it is being managed at Quant Mutual Fund, it is more towards a super active fund management than a trading strategy that's playing out. So it is active fund management happening at a different level altogether. That's point number one. And the second thing, unless you're a risk averse investor, I feel संदीप ने काफी अच्छे से पॉइंट आउट किया था कि जो शार्पर रेशियो होता है वो देखना भी बहुत जरूरी होता है. तो जो हमारे ऑडियंस है जो शार्पर रेशियो नहीं समझता है, उनको एकदम सिंपल में अगर समझाया जाए तो उसका मतलब होता है रिस्क एडजस्टेड रिटर्न्स, कि हर एक इंक्रीमेंटल यूनिट ऑफ रिस्क के सामने आपको कितना रिटर्न्स मिला है उस पोर्टफोलियो से. दिस इज अ वेरी क्रूड वे ऑफ एक्सप्लेनिंग, बट इट इज वेरी इंपॉर्टेंट टू अंडरस्टैंड दैट जस्ट बिकॉज योर रिस्क इज इंक्रीजिंग, it doesn't mean that that data point in isolation means nothing. You got to see if you're being compensated adequately for that incremental unit of risk, and that's what the Sharpe ratio is all about. And that's one very important thing that Sandeep has been talking about. So Sandeep, while explaining,
Yeah.
once again you brushed upon something that I am personally very inquisitive to hear more about. And through your literature, newsletters, the book that you have published across, there is this VLRT framework that you stand by really really strongly. So I feel it would help us a lot to hear it directly from you. What is this framework about?
So I tell you, we try to capture a multi-dimensional approach. Okay, where industry start looking at predominantly look at only on the valuation multiples, okay, or the so-called fundamentals. We talk about multi-dimensions, so we talk about the combining the qualitative, quantitative, and behavior aspect together, okay. And it is generally a myth when you talk about, a lot of people say if it is not fundamental, then everything is chart technical, which is not the case, okay. This is again a very big myth, because everything in what we showcase in a graphical manner does not mean it's a chart, okay. If any data points, if look at economist writing something, it is his or her fundamental data. If currency strategist is writing something about currency market or credit market, it is his or her fundamental data, okay. So every data for us is core fundamental data, okay. And there's a myth when you talk about fundamental versus, so it is just interchangeable thing, anything you don't understand beyond fundamental, everything is quantified. So technically that is a big problem for this industry, and that's the way we have been groomed, okay. Beyond fundamental, everything is technical, and then we don't understand. So the way we look at a multi-dimensional approach, so it comes from this background that we combine qualitative, that is fundamental, quantitative, which is part of quantitative way of definition, behavior, which is sentiments, okay. And through that we have built our core belief, which we put in a very nice manner: fundamental atma, liquidity, the prana, and sentiment, the maya, okay. So the sentiment is a very important, that is something when you talk about, okay, how you quantify sentiments, how you quantify sentiment mathematically. You can say I'm very bullish or I'm very nervous about market, and that is something, so far we are able to, we put in efforts to quantify these things through number. That gives me more clarity, when it is quantifiable. You can say this: when I say today the fear index is very high, or the capitulation is very high, or the euphoria is getting built, okay, or complacency is very high, okay, or vulnerability data point or vulnerability index is something is changed, or risk appetite has changed, it gives you some number that gives you confidence in taking a call. So similarly, the VLRT framework is actually derived from this. So we give one third weightage on the valuation analytics, which is one third weightage is given on the risk appetite, or one third in the liquidity. And T is the timing. Okay. And don't confuse timing with the trading or timing in the market in any
I feel
manner.
that is clear. That is completely clear so far.
Okay. So timing is a function. Okay. It's a part of a time. When I say timing is a risk management tool for us. Okay. And timing is a function of remaining three analytics. So liquidity analytics, risk appetite, and valuation analytics. When all three analytics or data is skewed on one side, it gives you better timing. Okay. As I explained you in March 2020, when pandemic unfolded, is that valuation got changed, or any fundamental got changed in that 2 weeks or a month's time, when we hit lower circuit on 23rd March 2020, and we made a new low on March 24? Nothing got changed, nothing. Okay. So your valuation metrics were as it is. What got changed? Risk appetite collapsed. Okay. What got changed? Liquidity got shrink for few days, but overall liquidity was very high, because right from 2008-9, after GFC crisis, the global crisis, okay, the central bank has been working in tandem, global central bank, and that was the case in pandemic. Okay. So you have a combination where the risk appetite and liquidity was changed completely, and valuation was static. Okay. So if you are a pure valuation analyst guy, you say, boss, nothing has changed. For us, okay, for us, 70% data has changed. Okay. And the impact of valuation will not be felt on immediate basis, because the valuation of fundamental get deteriorated over a period of time of such big development in next 1 quarter, 2 quarter, maybe 1 year. Okay. And some of the industry have yet not recovered after that fiasco. Okay. So it is not fair to say that what has changed, and that is the way this genesis of VRT came into picture. And also another thing very important, we keep on hearing in the media, sometime I watch, people say, oh yeah, valuations are stretched. Okay. Which means market is very expensive. Post COVID, when market started rallying in June, July, a lot of people on media came and said that, oh, it is tsunami, liquidity driven tsunami, so it is liquidity which is driving the market. Valuations have not changed at all. Okay. Then in last many months or last 2 months particularly, we'll say, well, sentiments have changed. Sentiments are very negative. Okay. So sentiments have changed. So okay, so I have given all these things. So valuation aspect we covered, liquidity aspect we covered, and risk appetite, which is sentiments we have covered. Okay, so that's the reason when you see the picture of a VRT framework, we put in a clock sort of thing, and try to showcase a clock from a timing perspective and rupee as a symbol, and then the rupee we are trying to rebalance. So VRT framework is all about how dynamically we are balancing between that. When valuation gets stretched, we prune down exposure on certain sectors, certain stocks. When risk appetite peaks out, we prune down mid and small in our portfolio. When liquidity comes in and risk appetite is also rising, we build small and mid exposure or high beta names in our portfolio. So it's a combination which really help us in taking a big macro call or much multiple data points which we bring, so we actually look at most of the data points and it runs into hundreds and thousands of data points. Okay, so we are a big user of man and machine. We believe that machine is equally important, because in today's world you cannot process all these data in your Excel sheet. Okay, which is practically impossible. So you need analytics team, you need this mathematical mindset. Okay, you need to understand a lot of data points. Even we give a lot of weightage on the earth analytics data, how weather condition affects you. Okay, how environment affects you, how the crop yields are getting affected. Why we made this big call that 2020 till 2030 is the decade for agri commodities. Okay, in 2012 we have written that 2020 the bubble will burst and there's the biggest agri rally will come. Okay, and we showcase that. Why agree? Because we believe in 2018 global warming has peaked out. Okay, and because of global warming, Canada or US, the yields of these crop, particularly soya and corn, yields have peaked out. Because a lot of people say, oh, they are the big producer. No, because of global warming they were producing more. Okay, now it has its own impact. We try to see how the magnetic fields affects you. Okay, and how it affects the economy, and then it affects market. So we talked about in our book, if you read, we have said that Russia will re-emerge in 2018 till 2028 is the era of Russia for that particular 10 years or that decade we have talked about for Russia. And there's a time when we wrote this book in January 2019, there was no Russia war with Ukraine, or Russia was not re-emerging in any manner. But based on some of the data point, we showcase how data has changed and this will unfold. Okay, so this is something, our ability to read complex earth analytics data, I think it's going to become very vital go by day. So we have now, if you're talking about a longer term perspective, we are saying that from 2018 till 2040 we are talking about that we are in cold wet environment. Okay, when we talk about cold wet environment, means your productivity efficiency will collapse. Okay, and that's the one reason we are very bearish on Canada or US, or some of these countries, even Europe, where they will become extreme cold. Okay, and India will be one of the beneficiary, Asia will be one of the beneficiary of that. Okay, so everything doesn't, you don't get answer from your balance sheets. Okay, if you say that I read my annual report, I have done the sector understanding and I have a fantastic fund manager, it doesn't work. Okay, okay, you can get your entry right in some of the sectors or the stocks. Okay, but you don't get the big picture right, you don't get your exits right. The exits are equally important in the market. Okay, the sector rotation is vital. So that's the reason we talked about how weather condition will play a role on the agri side. Okay, and we are seeing how agri prices, we talked about 100 to 1000% return in agri prices between 2020 and 2030. With that background, we talked about that inflation will come back. So we have given a title called Return of the King. The inflation will come with a bang, and will create havoc in risk, both risk on risk of environment. Okay, so this is something which we wrote very early, and obviously if inflation moves up, so natural beneficiary will be the interest rates. So interest rates started inching up. So everything is linked. If you really try to connect, so we try to build a thesis from earth analytics to interest rates. Okay, reverse is not possible. With the crude prices, you can reverse and calculate and tell you there's a geopolitical volatility which is coming in, because I cannot forecast geopolitical volatility, but we can, because data points of crude or natural gas or any energy substitute. We have been very bullish for coal for a longer period of time. We are saying that this is the decade belongs to energy crisis is just unfolding. What you have seen a small trailer so far. We believe the bigger crisis is pending. Okay, globally, I'm not talking about India in general. Okay, you have their own fundamental data point for that. So once you so we actually work everything on the market employed data. So market employed something. Okay, that's the way we try to connect the dots with the predictive models. Okay, we connect the dot and try to see how the picture for next few months or few years is emerging. It is very difficult for me to talk about 20 years terminal value or 30 years outlook. So I don't have that vision to see what is coming in the thing, because our data points cannot talk about that big picture in terms of numbers. Okay, yes, we can talk about based on the earth analytics. We can talk about something is changing and something can change for longer term perspective, but it is very difficult to pinpoint the earnings of the company. It's very, very difficult to pinpoint which sector will change. So we look at the very larger macro and earth analytics picture and the global outlook, okay, from the multiple data points, and then come to sector and then come to stock. Okay, but stock and sector are has to be the near term, has to be medium term. I can't take a call on crude on 20 years basis. Ki now this is GRM will remain elevated for a 20 years basis. Okay, I'm just giving a small example, or this technology will last for long, or this is the a company which has the best brand value. We have seen, best of the brands have collapsed. When technology changes, very difficult. When a best of the promoter don't know what will happen in next 20 years, we wonder how some of the managers and the analyst community talks about next 20 years. It is beyond my imagination.
Lovely. I feel, Sandeep, wow, that was an amazing angle that you've given to investments, and your credibility as a macro strategist is well established. You are pretty known as a highly credible macro strategist. It's only now that I realize how macro do you start from, and it's completely amazing to hear it from you. So I have to ask you this. I just have to, for a very long time, 2019-20 types, अचानक से दुनिया का जो टोनालिटी था एक्टिव फंड मैनेजमेंट को लेके वो काफी हद तक बदल चुकी थी, राइट? और काफी लोग जो बात कर रहे थे वो पैसिव इन्वेस्टिंग के बारे में बात करने लगे थे, और कहने लगे दैट what has happened in the US will happen in India almost right now. It is almost as if India's vanguard moment is here, and काफी लंबे समय तक काफी actively managed funds ने काफी struggle किया to beat indices, like Nifty 50, etc. So these indices were on a one-way streak, but अचानक से काफी समय से एटलीस्ट पिछले कुछ महीनों से एटलीस्ट I haven't heard the word passive. So people are once again flocking to active fund management. So there's this entire sort of seasonality that I'm sensing in investors and analysts, cheerleading for passive funds versus active funds. Obviously, personally, I feel these are, I feel actives are also passive. It is if it is managed passively, and passives are active if they are managed well according to their methodology. I don't view a huge distinction, but different perspectives. What is your take on this entire active versus passive debate?
So I think you have put it quite well. Globally, I'm not talking about just India. Uh,
Yeah.
the genesis of passive was obviously when active fund managers have started underperforming, and that's the genesis of why the passive came into picture. And you rightly put it. If even you manage your passive fund in active manner, you will generate alpha. Okay, and if you even manage active fund through via passive thing, it's not necessary you will outperform the market. Okay, because I think everything has a cycles. Okay, let's look at when we talk about liquidity analytics, since we do very detailed work on that. Okay, the current problem in US, if you ask me, is is massive redemptions happening on the passive side, fund side. Okay, so it is not the active fund selling which is affecting the market. It is the passive market which is affecting us, because what happened over a period of time, when actively when you put money in the active, is a human psyche. When you put money, you're actively looking into it, or you believe this is actively managed from a longer term perspective. That's the way the genesis of the portfolio management, the mutual fund industry evolved. Okay, or the insurance company. But in last many years, particularly in last one decade, this passive has come. Okay, And a lot of people felt, the entry exits are very easy. I can enter anytime, I can exit anytime. I'm equally smart investor. I can time it market better through passive product. That's the thesis which got built. And when you are in secular bull run, that thesis got great endorsement. Okay. And now what is happening, that cycle has changed from September 2021, when we talked about this global euphoria is there, and particularly our uh, vulnerability indicators for US market was on the highest level at that point in time, and then you see the what is the outcome. So now that something reverse is happening. Okay, people thought as entry is easy, I can book it. Similarly, when they want to move out, so this is like there is no attachment. Like active fund, you put money, you have attachment from a longer term perspective. Since we look at behavior data more closely, there's attachment. But in passive fund, there is no attachment. If you even a small loss or small, you will move out because you think this was my uh, I don't know how to articulate that, but there's a attachment, less attachment is there in the passive fund, is more attachment, okay, in the active fund side. So I think that cycle is played out quite well. And I agree with, in India is still in very early stages for passive fund. That's the reason India, another data point we showcase that India market has not peaked out. But the one condition will be that the passive has to grow significantly, purely from my liquidity analytics perspective.
Yeah, yeah, amazing. I feel there's a lot for the audience to take away, because we have been hearing about this active versus passive debate for a really, really long time, and I feel you just put a lot many things into perspective for most of them. So, Sandeep, as we move towards the fag end of this conversation, there are a couple of questions that have come up, and I'll just try to take a couple of them
Yeah.
before we move towards the end. So the first question is, every fund house has a distinct approach in managing aggressive hybrid funds. Even you seem to have one. Can you please elaborate on how do you manage your aggressive hybrid fund differently?
So let's understand both. So aggressive hybrid fund, we have a call known as quant balance fund. Another hybrid fund is also the multi-asset fund. Okay. So on the balance fund, what you call it, quant absolute fund, which is aggressive hybrid fund, we are obviously, we take less risk. When I say less risk, it is predominantly a large cap biased. Okay, I'm not saying that we have a, as a fund house, we always talk about unconstrained. That's something you talk about, active, absolute, unconstrained. These are the investment thesis. So we like to be as unconstrained as, but given the environment which we are in right now, and right from September, October, we have increased our large cap exposure. So given the current environment, we are running as a large cap biased fund, which is relatively so-called perceived less risk in the current environment. That's the way we run it. Okay, and when it comes to multi-asset, we manage it very different from the industry is typically give one third weightage on the bullion or equity or fixed income side. That's not the way we run it. Okay, we run it very dynamically. So we can go up to 80% cash, we can go up to 80% bullion, and we can go up to 80% equities. Okay, and remaining 20%, if we want, if the circumstances are bad and if you think this is the environment, then definitely we can hedge that also. But so far we have not felt the need of that. Okay, so based on our research, the quant global research outlook, we take calls on the bullion market. So like in the March to, or if I'm not wrong, July, August 2022, it was skewed towards gold. And since then it's skewed towards equity. Only last 2 3 months or few months, again gold exposure has marginally moved up from 10% to 20, and now maybe 18% or so. Okay, so depending on the view which is backed by data or our analytics tools, we try to increase our asset allocations accordingly. So it's a very dynamically managed fund, and uh, I personally believe this is a great product for this industry, and even as a fund house, we think this could be one product which will differentiate us in a big way going forward also.
All right. I feel this more than just answers that. So the next question is also a very interesting one. I feel this is something that many of us would be interested in hearing more about. In your vast experience, what is that one big mistake that investors repeatedly make during heightened volatility like now, and that they should absolutely avoid at all costs?
So I tell you, the it's a not valid for it technically it's valid for everybody. Even it's still valid for me also. We have also lost good amount of money in the past. When we used to put money our own, we have learned from our mistakes. Okay, the common mistake which people do is all about emotional attachment. At the peak of the cycle, the extraordinary conviction is there, extraordinary confidence is there. Okay, you not only put money, you go and convince your relative and friend circle also about this is the best time and this is the best decision you have taken, you are fully invested, or you are keep on adding. When you see this sort of environment around you, and you also analyze your own behavior, that the amount of conviction or confidence which you have. Okay, a lot of people forget mutual fund, they go out and build leverage exposure in the market. Okay, this is a typical the cycle, which hurts you. Those are the times which you should avoid. Okay, and so is the case with the bottom also. A lot of people after 30-40% correction only realize that market has corrected. And that's the way the panic happened. And I've seen most of the time a lot of investors actually get capitulated at the bottom of the cycle. Okay, so I think biggest learning is that your biases has to be removed. This is what we try to do. We also make many mistakes. It's not like we don't make many mistakes. As long we are human being, we'll make mistakes. But the challenge is, or the good part about us is that we put process for that and we run through pro systems. We don't try to repeat the same mistakes. And if you can learn one this art, at least don't repeat your mistake. Okay, then you can be a very good investor.
Right.
Learn
I
from the
feel
mistake.
absolutely, absolutely. I feel, along with being an investment lesson, I feel that's also a pretty valid life lesson, right? It's okay to make mistakes as long as you learn and don't repeat them, right? Always find a new mistake to make. That's okay. It'll just make you a better person, a better investor. So fantastic, Sandeep. I'm really glad we had this conversation. This brings us towards the close of this conversation, but I would really, really look forward to have another conversation on yet another topic on someday. I feel your perspectives have really opened my eyes, and I'm sure the audience would have been busy taking notes, because there are certain angles and certain perspectives that I'm going to rewatch this video. Sandeep, thanks a ton. It was amazing talking to you, and it was totally enriching as an experience. Thanks a lot for your time and your perspectives.
Thanks, Nirav. Thanks, everybody. See you.
Thank you.
Bye.